So all yours, Richard.
Okay, well, good afternoon, everybody. So I'm Richard Holling, and I'll just give you a little bit of my background. So I'm not your typical finance broker, in that my background is actually 25 years working for IT companies. So I worked 20 years with Hewlett-Packard, 3 or 4 years with SunGard, which then became FIS, and then 5 years for a software house down in South Wales that was taken over by Tech Mahindra. But about 2 years ago, I decided, or 3 years ago now, I decided to take a change in direction and leave the big corporate IT world. And I joined a couple of fintech startups and got involved in helping small businesses get finance. In that particular case, the first startup I was with was invoice finance, and then the second one was working in the expenses area with a prepaid travel card. And then last September, I set up on my own as a finance broker. So I guess, like a lot of you, in terms of setting up your own business, timing is everything, and my timing was lousy. So Brexit, elections, and then COVID, not exactly the best time to start, but I'm still here, and I made a small profit for the first year. So I guess if I can do it in those conditions, I can do it anywhere. But anyway, what that means is that in terms of my approach to finance, I come at the business first, trying to understand the business, and then match the finance options to the business, as opposed to a lot of my colleagues in other broking firms and in the lenders are often ex-bank managers who've got 20 years experience of banking, and their approach can be more bank centric from a product point of view rather than from actually looking at the business need. Anyway, so that's my background. Let's move forward. So what we're going to cover. So in many ways, startup finance is very similar to finance just in general, in terms of the types of lending and loans that are available to more mature businesses. So the finance I'm going to be talking about is debt finance. So that's basically either the owners or the business itself borrowing money from a lender. And for the majority of you, those lenders will be from the alternative finance market. And what do we mean by the alternative finance market? Well, so everybody's heard of the NatWests, the Royal Bank of Scotland, the Lloyds, and such like big high street banks. Well, we've seen over the last 10, 15 years that those banks have stopped lending to a lot of small businesses. It's no longer economical for them to do that. They're preferring to loan larger amounts of money to much bigger businesses, or making money in other ways. So that's created a gap, and there's a need then for businesses like yours to borrow money, and that gap has been filled by what we call the alternative finance market. So they're a mix of smaller banks, the challenger banks, people like Starling and Shawbrook and Aldermore. They're also alternative lenders who are not actually banks at all, they're lending companies. So you'll find this market is broadly or mainly unregulated from the FCA, in that people who are deemed to be running their own company are deemed to have more knowledge and savvy than your average consumer. So that's why the market's unregulated. That may or may not change in the future, but at the moment, around about 83% of business lending is unregulated, and that's not because it's going around the rules, it's because there are no rules other than the standard sort of fraud and general trading sort of rules. Okay, so we're going to cover business finance requirements, why you might need to borrow money. I'm going to specifically talk about the government startup loans program, which is a program for businesses that are under 2 years old, and is perhaps one of the easiest ways of borrowing money if you're very much in a startup situation and you can't actually fund the initial stages of your startup yourself. Then we're going to go over the different finance options, the benefits and drawbacks of these, the relative costs, and how easy it might be for you to get the loan. And then I'm going to talk about people like myself, brokers or financial advisors, and how we fit into the picture, why you might want to work with somebody like me, or why you might want to work directly with a bank or other lending organisation. Then I think it's important that you understand how to apply for a loan and the criteria that the lenders use. And then we'll go again over just some of the products. Now, the way this I want to work this is that if you have questions, please put them into chat, and Ant will look at those, and periodically I'll stop and we'll just review if there are any questions to the content that I've been talking through. What I don't want to do is talk for 40 minutes without it confirming that I'm giving you the information that you want to hear. Okay, so what's driving your need for a loan? So these are all, the legitimate areas that that a lender will understand if you're wanting to borrow a loan. So seed funding, so that's getting your business off the ground in the first place. That's the initial outlay on stock. It's buying in some expertise in terms of building your products, if it's software or whatever. Now that's really where so for seed funding, you're either going to have to go to an angel investor, which is not something I can talk to. You're going to go to family and friends, or you're going to fund that from your own pocket. If none of those sources are available to you, then that's where the startup loans program comes in. And there, for the startup loans, which I'll go into detail in a few minutes, but basically you can borrow up to £25,000 per director over a period of 5 years, and that's at a fixed interest rate of 6%. It's sort of a personal loan, but that sort of gets you the money to get yourself up and going. You may have already been started, you may have been trading for 3 or 6 months, you've proved your business concept, but you're now in the stage where you need additional working capital and investment to be able to take your business to the next stage. So things like increasing stock, your range of stock, or just the depth of stock. You may have won a large contract, which means that there's more work in progress going on, and a delay for you actually getting paid. So you've won a big contract with, say, supplying, I don't know, ketchup to Ocado, and you want to be able to finance that and invest in new equipment to produce the ketchup, or you need to be able to produce in larger volumes and buy in large amounts of ingredients. Or it may be that just the new contract means that you've got to wait 60 days or 90 days to get paid. So you've got new payment terms along with that, which means that you then have a shortfall in again, working capital. Or you may be going into a new sector. So recently I did a loan for a carpentry company who are now moving into the electrical sector and mechanical sector in terms of construction at high-end homes, and that they needed the money to hire new people and expand into that area. You may need money for new premises. So if you've, for example, if you're a startup in the, I don't know, childcare area, and you've had one of these indoor play areas, and you're looking to expand to a second one, or a cafe, and you're looking to buy out the lease, or a second cafe, then new premises is obviously a good reason for borrowing. And also buying another company. So it could be that you're an entrepreneurial person, but what you're actually trying to do, rather than start your own business completely from scratch, you want to acquire a business. And that is, again, obviously a good reason for borrowing money, and lenders will lend against that. Now, one of the things you'll have noticed is nowhere there is anything personal. So these are business loans. So you can't, if you're a startup, you're going to be on very shaky ground if you're borrowing money to fund your own time for the first 6 months or a year of the of the startup until you're actually generating revenue. Most lenders will assume that you can self-fund your own personal life without taking the money out of the business for that initial period. And certainly the startup loan program takes that attitude. So how much should you borrow? This is something that if you've got an accountant, you could work with the accountant and produce a cash flow forecast. So the cash flow forecast should be for 12 or 24 months and should include the repayment of the loan in the calculations. And just look at what the peaks and troughs are in terms of your income over that period, and make sure you borrow enough to cover all those. Because once you've got a loan, getting a second one may be more difficult. So it's important that you borrow enough money and you borrow the right amount of money. And then also consider, what you want to do, the period of time. Because obviously a longer period means that you'll have longer to pay the money back, and the individual payments will be less, but overall the loan will cost you more money. And then the thing that I always say to everybody is consider the alternatives, because borrowing money is going to cost you money. And particularly at the moment, we've seen a lot of businesses take on a lot of debt because of COVID, the COVID situation, but all that money's got to be repaid back eventually. So you really need to look at how can you, do you really need to borrow the money? Have you got any alternatives? Like, as I say, not drawing a salary yourself, looking at your payment terms. Have you got customers that are willing to pay you, cash on delivery or within 5 days instead of 30 days? So that could increase your income, or even just putting up your prices could actually give you an ability to generate more cash. Right, so these are the different sort of finance options available. So I'm not going to go into them all in detail now, because I think everybody will fall asleep. But we are going to go into the startup loans. That's going to, because I think that's going to be relevant to a lot of the people on the audience. We're going to talk about revolving credit overdrafts. So this is just like could be just like a personal overdraft. You basically draw it down as and when, and it's part of your bank account. But increasingly, we're seeing that the main high street banks are charging ridiculous amounts of money on overdrafts, or also not making them available to small businesses and particularly startups. So you may want to go to one of the other providers where they provide exactly the same thing. You just draw it down when you need and transfer it into your bank account for spending, and then pay it back and draw it down, pay it back. So it's a credit facility that's available to you, but you don't have to, it's not a loan. You don't draw down the whole amount of the loan in one go. You can, but then you pay it back on out of income quite quickly. So they're fairly easy to obtain for low amounts. The cost is relatively high compared to most things. Then we have unsecured loans. So again, this is people like iWalker, Just Cash Flow, Fleximize would be lending companies which are going to give you a loan, and that's usually just secured against the asset. That will be unsecured and will be based only on the cash flow and the profit and loss of your accounts of your company. So that's going to be harder to borrow for a startup because you haven't got the track record in terms of you being able to show that you are a profitable business. You probably haven't filed accounts yet, and everything's just doing on a cash flow forecast. Then you have secured loans. Now, these could be secured against the assets of the company. And obviously in startups, those assets aren't going to be very much unless you've put in money to buy premises up front. Or they could be secured against your own personal assets and directors' guarantees. So quite often what a lender will do is when they lend money to a company, they will ask the directors to back the company, which means that should the company default on the loan, then the lender will go to you as a director and ask you to make them good. Now, those directors' guarantees form part of the secured loan, and they could be just on the basis that they think you're financially secure, you're a homeowner, and they just take your word that you'll be able to meet the obligations should your company fail. Or they may be asset-backed guarantees. And what an asset-backed guarantee means is that they actually put a second charge on your home. So your home basically can't be sold without the permission of the lender. That way, and if you do that, generally the cost of the loan will be a lot lower than it would be if it was completely unsecured. But obviously, then you're putting your own personal assets at risk rather than just the company. But you have to ask yourself, remember, these are banks and lenders lending you the money. They're not angel investors. So if you're not willing to put skin in the game, for want of a better expression, why should a lender put skin in the game? And that's you've got to remember that that's part of the reason why they look for this security. It is actually to make sure you're committed to the business. The next type of lending that may is one for potentially for startups who've got perhaps 6 months trading history. So I noticed somebody was setting up a cafe. I think there's somebody else in the childcare business. So what a merchant cash advance is you borrow your takings on cards. So, for example, if you're taking £50,000, well, I don't know, £10,000, £20,000 a month on cards, then what you can do is you can borrow that amount of money from a merchant cash advance company, and then they deduct payment from your card receipts. Why might you be interested in that? It's a secured loan then against those card receipts. If you have a good month, and then they'll take more back off you than if you had a bad month. If you have a bad trading month, then they'll take less. So it's a very flexible repayment scheme. It's best to be used for just short-term lending because the cost is relatively high. So if, for example, you see people using that if they're in the hospitality sector and there's an event coming on. So, for example, the World Cup or Wimbledon or rugby event, and what the venue wants to do is get an extra stock to cover that period, and normal trading cash flow doesn't allow them to do that. So they take a merchant cash advance, say £10,000. They buy an extra £10,000 of beer and snacks in, and then they sell that over very rapidly over a period of a week of the competition. And because that additional stock is at a high margin, it more than covers the cost of the lending, and everybody's happy. It's not particularly good for stocking, for buying stock in which has a low turnover. You're better off going for other types of advance. The next thing we have is trade finance. So trade finance is for international trade. So that's bringing goods in from overseas. And the way that works is you as a business, you may be adding value to a product that's been manufactured elsewhere. So you're bringing in ingredients into the UK, and then you're transforming those ingredients and you're producing an end product. What trade finance can do is fund that supply chain from you to your suppliers in India, Brazil, or wherever they are, Turkey, France. And what will happen is the trade finance company will pay your supplier. When those goods come on shore, you then either you pay the trade finance company to get back at that point, and then you will obviously transform the goods and sell them on. Or if they're goods already ready for shipment to customers, then you can you basically pay off the trade finance loan with invoice finance, which I'll talk about in a minute. So ideally, for trade finance to work properly, they like to see an end order from a UK-based customer to give you the finance, but it's not all the case in every case. Next, we come on to, so that's, if you like, financing supply inputs into your business. Trade finance doesn't have to be international. It can also be within the UK. And then finally, we have invoice finance and factoring. So what are these? This is basically you invoice your customer, a customer like, I don't know, Ocado or British Aerospace, maybe assuming that you're giving them payment terms of 30, 60 or 90 days. They may sometimes be late. And obviously that's a long time for you to be waiting to be paid. And what invoice finance and factoring do in slightly different ways is basically buy those invoices off you and give you the value of the invoice up to an agreed limit straight away, which stops you having to go for an overdraft and decreases the amount of money you need in terms of working capital. They are relatively expensive in terms of a financing option, but as a startup, it may be one of the few ways that you can actually borrow large amounts of money. It may be that you can't get the overdraft or the revolving credit line that you really want, or a secured loan because you've got no assets. And then finally, we've got equipment leasing and assets. So then again, if you're a manufacturing company and you're looking to have equipment, then often a specialist finance company will buy that equipment and then lease it back to you or give you a loan based on that asset. Right, I'm just going to pause and let's see if what we've got in the chat. And we got much going on?
Yeah. So the big question on everybody's lips, Richard, is why are you in the middle of a field?
Right. Okay. So so my company is called Berkshire Dales, and there are no Dales in Berkshire, but we have ponies. So I've got 2 Dales ponies from Yorkshire, which is where I'm from. I'm from Sheffield, and my partner's from Sheffield. And so they're Dales ponies, they're native breed, a rare breed, and we're in Berkshire. So Berkshire Dales is the name of the company, and all my branding is around ponies. So anybody who follows me on LinkedIn, you'll know that every night I post a video about me and my ponies. And I figure that horses have figured in Lloyd's Bank's adverts for donkey's years, and they've been relatively successful.
Fantastic.
And Warren Buffett is the richest investor in the world, and his company's called Berkshire Hathaway. So I thought, Berkshire, something's got to ring true for me. So.
Perfect. Well, I mean, and that might sound like a silly question, but you've got something about you there that people will remember, and I guess that's important in any business.
Exactly, but also I'm rural. So, I mean, I've worked mainly in London and overseas, but right now I work in the countryside, and I'm interested in country businesses as well. That's part of what I do.
So a couple of questions. So the pony guy. Thanks, Toby. So what you're describing here is from a UK context, I'm assuming.
Yeah.
Some of this may or may not be similar in a global context, but that's not the topic of today's discussion.
Yeah, I mean, so I'm involved only in UK businesses. So things like trade finance, if you're an importer into the UK, then making your customers aware of trade finance might be a useful thing. But if you're a startup business in Lithuania or China, then there's not an awful lot I can do to help. You've got to look to your local banks for that.
Okay, fantastic. And I mean, that's relevant because we do get an international audience on these sessions, Richard. And then another question, just for we've got to remember that sometimes we use terminology that we might take for granted that not everybody understands. So angel investors, then, how would you describe an angel investor?
Okay, so an angel investor, so they're people who invest in startups. So what they do is they will look at the individual, about their capabilities and their track record in a sector. They'll look at your business plan. They'll look at the sector as a whole, and then really they'll take a bit of a risk in terms of buying into your company. So they'll take a share ownership of your business, and they'll give you the money to get you going. The way they make money is they will invest in between, I don't know, 5-10 companies of a similar amount. They may be part of a network, and you get 2 or 3 people investing together to share the risk. And they assume that only a quarter or a third, if that, of those businesses will actually make it. So, and they assume by taking a big enough equity stake that will cover the losses on their other businesses. And there are tax advantages for doing that as well. There's some, creative tax schemes that allow them to invest in businesses, but they're really putting their own personal wealth at stake, and it's all about the credibility of the founders of a company. That's very different to a bank or a lending company, because a lending company is lending you other people's money. So they need to have a much higher level of security and confidence that you're going to be able to repay the money back. So it's one's equity and is more of a partnership, if you like, with you, whereas one is a loan.
Okay, fantastic, thank you. A good one here. So Jonathan, who mentioned the cafe bar earlier on, and we'll be specific, but I guess there's a general message here. So they're not planning on opening the cafe bar until early 2021 and planning on self-funding it. Is it sensible to take some sort of finance to get their credit rating for their new company started?
Do you mean that you won't get any credit for the company anyway, because they're not trading, so they won't be able to borrow any money.
Okay, so
unless you're trading, you won't be able to borrow any money unless you go for a startup loan. And a startup loan is the way those, I'll go into the details, but actually it's a personal loan. So they're lending you to the, so if I borrow a startup loan, because my business is only 12 months old or 14 months old, so I'm still eligible for the startup loan, I would borrow the money as Richard Holling, and I would have to invest it in my business, Berkshire Dales. But it's a personal loan. It's not, so the credit scoring is on me as an individual. Okay. Now, if you're in a startup business, you need to have a good credit rating yourself. I mean, the better credit rating you have as an owner or a founder, the better. But don't just borrow money for the sake of it. I mean, check your experience score, or your using one of the other credit checking apps. Monitor that, and actually have a look at the best way of improving your credit score without borrowing money, because at the end of the day, borrowing money costs you something, and borrowing money only improves your credit score if you borrow it and pay it back. Once you've borrowed money, your ability to borrow further money can be restricted depending on what your income is. So yeah, I'm not necessarily going to recommend somebody borrowing money to improve their credit history if they're about to start a business. Okay. And the business itself, unless it's trading, won't be able to borrow money.
Okay. And Jonathan's clarified and said he meant to say after they're trading. Sorry, let's get rid of that one. So another question, how do you improve or check your company's credit rating when you're within the first 2 years of trading?
Okay, that's fairly easy. Just go to Credit Safe. Okay. So there's an organization called Credit Safe. There's the chat.
Okay, probably easy to find on Google.
Yeah, okay, yeah, it's fairly easy to find on Google. Let me just
so you can check your credit rating for your company there.
Yeah.
How do you improve it and is there a point where lenders will stop asking for directors' guarantees?
Yeah, so the way to improve it is make sure you file everything on time. So you need to get your accounts on there. So I had a situation this year where we've got a company that it's no longer a startup, it's in that growth phase. So I think they're 6 years old, but they were loss making for the first 5 years. And they wanted to refinance some of their debt. And they also have been hit by, like everybody in terms of COVID. So they wanted to be able to borrow a couple of CBILS loans to tide them over the next and basically sort out some of their cash flow issues. Because they were loss making for the first 5 years, nobody would touch them. But the last 12 months, the last set of accounts, they actually broke through and started to make a profit. But they made the mistake of applying for loans before they filed their new accounts, if that makes sense. So they got the accounts, they knew they were going to be good. They got management accounts that showed them would be profitable, but they didn't file them straight away. There was a delay, and they applied for the loans before they filed them. As soon as they filed them, their credit rating went up, but it was already too late because the lenders that they'd approached you get one chance with the lender. So funding options, for example, which a lot of people have heard of, they have certain criteria, and if you don't meet that criteria, you're not going to get a funding options loan. But if things are going to change for you in the near future, like filing a new set of accounts, you've just got to wait until you file them. Don't apply and then think you can have a second chance, because you won't. So the best way of increasing your credit rating is file everything on time and then run a profitable business. Because if you're not making any money, you won't be able to borrow any money. You've got to be making a profit.
Fantastic. Well, I suggest we move on. There is another question, but it's more about how can you help people in this process, which I think is what you're going to cover.
Yes, yeah. How are we doing for time? All right. Okay, right. So first of all, I'm going to make the slides available to Ant, who's going to send them out to everybody at the end. So even if I don't cover everything in the presentation, you'll get the presentation. So startup loans. So this is available to anybody who is just starting up. It's a government-backed scheme. It's a personal loan. So you are responsible for paying it back. You're allowed to borrow up to £100,000, depending on how many directors you are. It's relatively cheap at 6%, and you can borrow between £500,000 and £25,000. The other thing about the startup loans is you're given advice during the application process, and also for the first year of your trading, you'll be assigned a business advisor who will work with you to help you through that early stage. And the way those loans are lent is you write a business plan and you write a couple of cash flow forecasts, one for your business and then a personal cash flow forecast for your own situation, so that the lender knows that you're not going to be drawing down too much money out of the business, and you're actually financially secure yourself. Right, so let's talk about how lenders make decision. So there are basically two types of lenders. There's we've got lenders on the left, which what I would call are basically what we the criteria that a lender will use are basic what we would call campari, which is basically an old banking term for the character of the individual. So is the person who's the founder or the owner of good reputation, good ability? Do they have relevant experience in the sector? They'll be looking at ability to repay. So that's the most important criteria of all. So in terms of your forward-looking cash flow projections for your business and also for your accounts, you've got to show that you'll be able to make the repayments of the loan. And that's not scraping it through by the skin of your teeth. You have to, in many cases, have 2 or 3 times coverage of the loan payment. So what does that mean? It means, say you borrow £15,000 over 5 years. That means you've got to pay back £300 a month. So you've got to show in your accounts that you're making between probably £600 and £900 a month profit after directors' drawings. So you've got to show you've got an ability to pay. You got to have the purpose has got to be a legitimate purpose for the business. Then an appropriate amount for the size of the business. They're going to be looking at the repayment terms, so how quickly can you pay back, and then insurance in terms of if they're looking for security on the business. So they're the criteria. Then we have two sorts of lenders. We have a narrative-based lender, which I would call old school, which is a story-based. So they're looking to actually understand the business, looking at the business plan. They're taking apart the business, trying to understand understand the founders. If there's any credit issues with the founders or the business in the past, they want to understand that. So this is, they're not just looking at the facts and figures. Then you've got more modern lenders. who are typically the newer fintechs. So people like iWalker and Funding Option, and they're algorithm lenders. And what they basically do is they take the criteria that I've talked about on the left, and then they analyze your accounts and add in other public information, such as the sector information, average profitability of the sector, etc., growth in the sector. They will also look at things like your bank account, and some of them do things like what's the average value of your invoices, number of invoices a month, and they will then use that in a big formula and decide whether or not you're going to meet their criteria. And that's quite binary. You're either going to meet their algorithm requirements or you're not. So depending on your business and the stage you are, then you have to make a decision whether you're going to be able to meet the criteria of an algorithm lender, or you're going to have to go to a story-based lender, and they are very different. Right. So let's. How do I get rid of that? Okay. There we go. No, there we go. Right. So now we come on to how do I help? Why use a broker? The reason why you might want to use it, if you're already savvy about lending, you can probably work with your accountant to produce the documentation that you'll need in terms of your business case and your financial plan, and approach your lender direct. But the problem with, well, not an issue with that is if you approach one lender and they don't lend you the money, where do you go next? And also that lender that you've approached, are you actually going to get the best rate or the best type of finance for what you're doing? So if you just go to Google and you Google business loan, you're going to get Funding Options, iWalker, Funding Circle, and a couple of others. Now, how do you decide which one's the best for your business? And the rate that they will quote on their website and the rate that you'll actually get will be two very different things. And all actually you're doing is borrowing from the person who paid the most to Google to get the higher up in the rankings. So you have no idea whether you're getting a good deal. You have no idea in advance whether or not you're going to meet the criteria, because the criteria they publish on their website are not always in detail, because they don't want people gaming the system in terms of applying for loans. So a finance broker will basically work with you, try to understand your business, and then present you to the right lenders. So there's another type of lender that I've not particularly talked about, which is what's known as a responsible lender. Now, if you Google responsible lenders in the UK, you'll get a website with another bunch of lenders on them, which are part of the alternative finance sector. And those alternative lenders lend on the basis of social good in many cases. So they're looking for businesses that are creating jobs. So many of you are startups. So you're creating employment, and then you're of an interest to the responsible lenders. Now, the trouble is responsible lenders are regional and sector based. So, and there are a lot of them. So it's very difficult to navigate through that, which is again where a broker will come in. We'll be able to tell you whether or not what you're trying to do in your business is going to be of an appetite for a mainstream bank, whether it's going to be good for an algorithm lender, one of the alternative finance houses, or whether or not you're going to have to go to the responsible finance sector. All of them have different criteria and also different charging. So the responsible lenders may well actually lend you the money, but they may be more expensive than a more commercial lender. So it's just, you have to decide. It's a trade-off. So the other thing, so what's happening is the broker will help you navigate that. It's been proven through statistics that particularly over the last 6 months, that people who applied for a CBILS loan using a broker had a much higher chance of success than if they just applied directly. And yeah, because some of you just you wouldn't know which lenders would be willing to lend to you for what purpose. So only certain lenders will lend for business acquisitions, for example. And again, a broker can navigate through you. I've also known some lenders refuse to lend to somebody because they've been turned down by too many other people. So again, working with a broker, they can ring up the lender, have an informal chat, just find out whether or not there's going to be the loan's going to be of interest to the lender before you actually formally apply, and because they've got the relationships to be able to do that, which again gives stops you applying too many times, and then also in terms of the speed, if you need money quickly, then applying directly without knowing whether or not you've got a good chance of getting the money is just going to burn time. So that's why you should use a broker. We're not free. We typically charge between 2 and 3% of the loan value, up to about $1 million. Over $1 million, we would probably charge less. We'll charge less than that. But we're a bit like a mortgage broker in that the lending company will quite often pay our fee. So you as the business don't pay it, but some lenders won't pay us a fee, in which case we do take it off you. So that's where I come in. I think what I'd like to do is go back to questions, Anne, because for the last 10 minutes.
Yeah, certainly. And as you say, we'll share the slides. There's an awful lot of information in there, and I guess the great thing with these slides is some of this might not be right for you just now, but you keep these slides, and in 3 months' time, 6 months' time, you flick it out, you take a look. It gives you half the answer there, and you ring up Richard and you say, well, I'm in that position, Richard. You described it. I need some help. What do you think I should do?
Yeah, exactly. So, I mean, most brokers, well, a good broker will give you 15 minutes, half an hour of their time just to understand where you are, and then they'll tell you whether or not they're willing to work with you. And most of us will work on a no fee, no success, no fee, or success only base, fee base. If we think you're going to be a difficult case to place, we may ask you to pay up front, but we'll be clear about that. I think we don't make our money by not getting people money. You see what I mean? Yeah.
Okay. So Richard will leave that slide up for a little while. So make sure you scratch down those details, and I'll ask you some questions, Richard. So a question here. So coming back to the startup loans, could someone who's on universal credit be able to get the startup loan? I guess that comes back to that forecast.
It depends what your business is, and it's all down to the quality of your business plan. So if you're, I mean, and your realism. So don't look to borrow 25,000 to start a Lamborghini car hire business, because you're not going to get the money for that. But if you're going to set up a coffee shop, on a road where there's no other coffee shops at the moment, or you're going to start a takeaway sandwich business or something, where you've got a realistic plan, and you've got there's no reason why you shouldn't be able to borrow the money. Okay. So I mean, but it is down to the quality of the plan. And it's easier if you, for example, if you've been working for Debenhams, for example, and you've just been made redundant from Debenhams, and that's how you're on universal credit, and you want to go into set up some sort of fashion boutique, I'm just picking things off the top of my head, then you've got relevant experience. It's a relatively low amount of money you might need to borrow. You can write a business plan around that, and provided you're realistic, there's a reasonable chance you'll get the money.
Okay, fantastic. Another question here then, what's your thoughts on crowdfunding to raise capital? Okay, so
I suppose there's different types of crowdfunding. If you're looking, so it's equity, it's not debt. So I do debt, not equity, but I do know a little bit about crowdfunding. So if you look, there's a fintech company that I've done, I know quite well, called Coconut. that they do business accounts for freelancers and sole traders, and they've done 2 or 3 net successful rounds of crowdfunding now. One of the issues with crowdfunding is you have a lot of shareholders, each investing not a lot of money, and then you have to manage that communication. So, you know, there's an overhead in terms of communication there, but I mean, it's a value, you know, it is a reasonable source. The other way of funding is similar, but not crowdfunding, is Kickstarters. So basically, if you're a startup and you're about to, and you've got a new product, so I don't know, say you're in the what, you know, you just started up a new business, you can't see it because of the Zoom, but wallets, for example, and you decide that you want to you've designed a new fancy wallet, or one of my hobbies is Dungeons and Dragons, the games, and so I buy these little packs of figures, for example, and these are often funded by Kickstarters. So basically, what you do, you go to Kickstarter, you create an account, you put your design on there and what the product is that you're trying to sell, and you take pre-orders. So you take like 1,000 pre-orders, you get people to pay you up front, and then you use that money to seed your company. So depending what you're trying to do, I would recommend Kickstarter rather than crowdfunding, because that way you've actually got real orders, real money coming in. But the key with Kickstarter is you've got to have you've got to make sure that the Kickstarter is profitable for you. So don't give away the goods. You've got to charge the right amount.
Okay.
That makes sense? Yeah.
I think it does. And yeah, someone said, oh, Kickstarter isn't crowdfunding. I guess in one way it is.
No, it's not. It's an alternative. Yeah, but it's a crowd and they're giving you money. So it's not equity, though. It's not an investment, which is.
Yeah.
Yeah.
Okay. So question from Victoria here. With an unsecured startup loan, what happens if your business fails? I assume you as an individual have to make the repayments, or would it be the business that goes bankrupt?
No, because it's a personal loan.
I want to make sure that my family won't be penalised by my business decisions.
Yeah, it's a personal loan, so you are. Now, my understanding is they rarely go after the money. But you are, so, legally you're on the hook, but they rarely go after you. So, I mean, it's one of those cases where if you've committed fraud, they're going to come after you. But if you've been trading and you've given it a good go and it just goes foot, then you can probably walk away from it.
Yeah. Okay. Okay. There's a little bit of a chat going on about crowdfunding, reward crowdfunding versus equity crowdfunding. It's not really your expertise, Richard. So
no.
Any questions for Richard around any of the stuff he shared, or anything about your specific situation, circumstances? Please type away. I mean, I must admit, I mentioned I'm a consultant. When we started our business, the thought of borrowing money to help us on those stages was terrifying.
Yeah.
We wanted to do everything we could, self-financing and earn a bit of money and invest it, earn a bit more and invest that.
I think it all depends on the startup cost. I mean, if you can do that, that's obviously the right way. But yeah, there comes a point then where if you're in a manufacturing business or a hospitality business where you go from being a startup to actually trying to go for growth, particularly like if you were, I don't know, you're making cream cakes. You can do so many cream cakes in your kitchen, and then there comes a point where you have to make cream cakes in a unit, and then you win a contract to supply a hotel chain, and then you can't do it in that small unit. You need to go to a bigger unit, and that's when you have to borrow money.
Yeah.
But then you're established. You know what you're doing. That's so somebody put their hand up.
Oh, we've not been using hands. Let me.
Was it? I can't see the attendees.
I see no hands, but anyway.
Karen, it was Karen Tolley, I think.
Karen, did you have your hand up? Did you want to ask a question? While Karen maybe types something. So Nombuso is saying, I Are your services global? Must have missed the answer earlier on. I think we confirmed that you're UK focused.
UK focused, yeah.
Okay. And sorry, it's Lucy, not Karen, from Karen. And she's asked via the question. So yeah, oh no, there we go. In the Q&A, crowdfunding / Kickstarter. My concern is that others, e.g. established manufacturers, will see my idea and copy it before I get there.
If you're worried about that, you shouldn't be doing it anyway.
So,
my gut feeling, you know,
protect your IP first, you mean?
Well, I suppose yes. I mean, like if you've got a business that's you've got IP that you can protect, then obviously get your trademarks and get your IP. Go talk down to the patents office and get it all sorted out in advance, or get a patent pending. But most businesses, startups aren't doing something like that. I mean, you're setting up something that can be easily replicated anyway, in which case you're relying on your own brand and your location and your personal connections to make your business work.
Yeah. And Karen's challenged me and said, I can't protect the IP. It's a fashion item and you can't trademark fashion. Advice ? Well, I'd love to be able to advise you, Karen, and I can ever so slightly, but not a lot. So earlier this week, I was lucky enough to sit through a 2-hour webinar on intellectual property. And we talked about trademarks, we talked about copyright, we talked about registered designs. Can you have a registered design for a fashion item? We talked about patents, etc. What the key thing from it was that it's complicated. It's not always as expensive as you think, but it's really important to protect your things if you want to try and make money out of them. And if you go to the Intellectual Property Office website, they have a lot of YouTube videos, they have health checker tools, and they have e-learning modules where you can go through those things and try for yourself. So hopefully that might help you, Karen. But if you are worried about a big commercial organization copying your idea, then yeah, you need to make as much money out of it as fast as possible before someone does it. Question from Marlon. What are the ranges of money, i.e. minimum to maximum, typically borrowed for trade financing?
So, I mean, minimum, you're probably looking at £50,000, £100,000, something like that. Depending on it, these lenders want something that's going to be ongoing and growing. So if you're a growing business and the first trade finance deal is £25,000 or £50,000, that's going to be fine. In terms of limits, then it would depend on your turnover and what the basis is. So if you're buying goods in, so let's say your company is designing something, doing all the branding, doing all the marketing, but having it manufactured in China. So the Chinese are actually building everything to your final specification with all your branding on, and you're only just then you're importing it and marketing it, and you manage to secure an order with Tesco's for that product, then the trade finance company will basically finance those goods for you up to the value or a limit of the value of the Tesco's order from you. So if you manage to land yourself a £10 million order from Tesco's, and then you need £5 million to give to the Chinese to make the stuff for you, then that's ideal for a trade finance company. So that's the sky's the limit. But to do that, you've got to already have been trading for a bit. Nobody's going to lend you £5 million just on the basis of a couple of pieces of paper, or have credibility. No, like again, if it's going to be easier if you've already spent 10 years in that industry or 15 years in that industry.
Great, thank you. And I've just shared a link to the OxLEP business support tool. So if you are in Oxfordshire and you haven't yet filled that in, we'd encourage you to do that. That is ultimately the reason why we're providing this support and why we'll carry on providing more support. If you're outside of Oxfordshire, it's probably not worth you wasting your time. Also, I've just shared a link to the YouTube account for the Intellectual Property Office. if I find any more links around what I've just mentioned, I will share them. But as I say, I watched a webinar, but I'm not an expert on intellectual property. Any more questions? Any more questions? I mean, as usual, the chat has been fantastic, with lots of people sharing information with each other and making connections. And, you know, we absolutely encourage you to work with each other and help each other. As I've said before, and Toby always makes me feel like saying it, you know, stay with Startup Club. So by all means, do all of these other things, but stay with us, because if you're connected with OxLEP, you've got more chance of getting support at the right time for your business. So please do stay connected. And if you fill in anything from OxLEP and you're asked, do you opt into marketing? We're not going to be spamming you with marketing, but if you opt out of marketing, we can't tell you when there's a £5,000 grant scheme coming along. So please don't opt out. So, and Toby's been listening to podcast of the Pop-Up Business School, which I think is great. They champion the idea of starting up without debt. Is that a realistic expectation for many businesses? I think you've sort of answered that, Richard. It depends on the business, doesn't it?
Yeah, if you're making cupcakes in your kitchen, then you don't need to borrow any money. But if you're equipping a restaurant, you know, in a old building, then you're going to need to borrow money. You're probably going to need to borrow money.
Yeah. Yeah, and there's a term called bootstrapping. Is that something you are familiar with?
Well, yeah, that's what I've done with my business. So I basically, for the first 6 months until I started to bring any income in, I cut all my costs. So I mean, I did a little talk on a video on LinkedIn, but basically saying, well, yeah, if you're starting up, then stop buying your stuff at Waitrose and start buying it at Aldi. You know, and you know, downgrade your car, get rid of the second car. Tell the don't put your kids in private school if you're about to do a startup. Keep them in secondary school, in state school, and just because the best way of not avoiding borrowing money is to not spend it. You know, and don't have an office. Work from home. You know, or work from the library. Work from the Costa Coffee, or better still, one of the other coffee shops that one of these guys is going to set up.
Fantastic. Yeah, and yeah, some of the group are saying that they already do that. So that's great information. Thank you very much, Richard. We've overrun ever so slightly. So some people have had to head off to other meetings, but I've found that really useful, full of energy. Love seeing the ponies, love the story behind that. And yeah, I mean, if there are other questions, Richard shared his information there. You know, please don't ask him to write you a business plan for your business or to do everything. You know, Richard will be happy to answer your simple questions, but he's like us. He's in business and he's got to try and make a living.
Exactly. I will write your business plan, but I won't be paid for it.
Exactly. Yeah. So hope you've enjoyed this Startup Club. We will share the video. We'll share the slides. We don't necessarily do that instantly. So, you know, if people are still asking me for the slides and video from last week, my apologies. We're just trying to get them all on YouTube rather than sending huge files across the email system. So thank you very much. Don't forget, there's another session next week and it'll be fantastic. So we'll leave it there then. Yeah, so I need to just download stuff, but if everybody wants to say goodbye and head off, yeah, we'll see you soon.
All right. Thanks, everybody. Thanks for listening.
And I need to download the chat before we go. Chat saved. Fantastic. We'll stop.